inspiring interviews with today's top landlords. This is the Rental Income Podcast. And now, Dan Lane.
My guest on the podcast today recently did something that's really pretty incredible. He worked out a deal where he got a free rental property. So I want to get some details and figure out how he did this. We're also going to talk to him today about his portfolio. He doesn't get a lot of turnover. His tenants really don't leave him very often. So I want to see if we can figure out what he's doing and how he gets tenants to stay. With that being said, he recently did have some turnover. So I want to see how that went and how that affected his cash flow. And we're also going to talk to him today about the market. He's really plugged into the market, and I want to see where he sees the market going from here and what he predicts is going to happen in the future. So let's take a real quick break. We'll thank our sponsors. We'll come right back and we'll meet Rich Levine from Maryland. The first step in buying a rental property is to get pre-qualified. And I would suggest you work with a lender that specializes in working with investors, because the last thing you want to have happen is to get to closing and find out the money's not there and you can't close. The lender that I recommend is Chaley Ridge from Ridge Lending Group. She's a nationwide lender, and she'll pre-qualify you for free if you mention Rental Income Podcast. Find out more today. Contact Chaley at ridgelendinggroup.com. That's RIDGE lendinggroup.com. NMLS 42056. Are you looking for actionable steps to create wealth and passive income? As a top-ranked business and investing podcast with over 800 five-star reviews, the Passive Real Estate Investing Show is packed with strategies and insight for putting money in your pocket. Marco Santarelli from Narada Real Estate Investments brings his expertise and knowledge on both passive and turnkey real estate investing, and he provides listeners with helpful tools and tips to create the wealth you've always wanted. Head over to iTunes or Google Play today and subscribe to Passive Real Estate Investing Podcast, or visit PassiveRealEstateInvesting.com. That's PassiveRealEstateInvesting.com. Hey, Rich, welcome back to the podcast. So this is your third appearance on the show.
Great to be here. I feel like it's a Saturday Night Live 5 hosting club. I want a jacket or something?
Yeah, we got to get you something. Definitely. So for anyone that hasn't heard your first two appearances, why don't you just give us a real quick background so everyone knows who you are?
Sure. I am in the DC metro area and got into real estate around the time the market crashed. I just didn't see a lot of value during the run up, and probably missed out on an opportunity, but certainly missed out on a lot of risk. Started buying rentals in 2008, 2009 after the market crashed in Herndon, Virginia. Acquired a number of townhomes there, and slowly over time have identified other assets and spots where I wanted to dive in. And now I'm up to about 26 rentals, and that's one piece of what I do. I occasionally flip a home, and I am a hard money lender and lend to people locally in the DC metro area for short-term projects.
Now, one of the things that I love about the way that you run your rentals is that you don't seem to have a lot of turnover. What are you doing to find tenants that are staying for a really long time?
That's a great question. In the Herndon market, that was a fallout from the subprime mess. So what happened was those people were entrenched in that area to begin with. They made a business decision that although they were paying double the amount of rent and highly levered, just didn't make sense for them. During the run-up, it made sense because their property values were going up and up and up. But when it all shook out, they walked out their front door and walked into the house next door as a rental for half the price, and they've just kind of stayed put in that spot. I have 6 single-family homes in the Montgomery County area outside of D.C., and I always require a 700 credit borrower. I just need to have somebody with good credit. And I give them a small break if they do an ACH auto payment. And what that does for me is guarantees the rent, so to speak, and makes it out of sight, out of mind for them. And I feel like if they cut a check every month, they think more and more about their rent. Whereas if they just kind of are on autopilot, they don't. And then there's a management company in place for 12 condos that are owned in Gaithersburg, and that, that ebbs and flows. Sometimes they're long term and it's great, and other times there's turnover, which happened this year, and that happens.
Yeah, so let's talk about this. So as much as you've really minimized your turnover in the last year, you've had I guess several of your units turnover. Was it really costly when your tenants left?
Well, it's always costly, but in particular, I mentioned those 12 condos. They were on autopilot for years, and the tenants were just kind of staying put. Last year, 3 or 4 of them turned over. That's life. It just happened to hit at the same time. I get distributions from the manager each month, and the distributions started getting lower and lower for several months because A, there was vacancy. B, when they turn over, I have to have them repainted and carpeted.
Yeah.
And then other, ticky-tacky things just so happened to happen at the same time, a few HVAC units and whatever. So the cash flow was down on those, but, you can't time when it's going to hit. It just happened to hit at once. Life goes on, and hopefully this year is very much smooth sailing on those units.
So
it happens.
When they turned over, like, you never had to actually kick in any money to get things going. Your distributions from your manager just were lower.
That's right. Let's say the 12 units net of everything, spit in 8,000 a month, let's call it. And there's debt and there's different things against it, taxes that have to be paid. The distributions just boom. It was 2,000. What's going on? Well, a couple of them are vacant. A couple of them had some carpet and other repairs. It's a lot of out of sight, out of mind because there is a manager in place. But for several months, the distributions were just simply low. I did not have to kick in because that manager keeps a small reserve per unit. I don't even think we tapped into that. What really ended up happening was nothing hit all in the same month. It just over the course of the year, there were a few vacancies, a few turnovers, and a few repair items that just crushed cash flow.
Right.
But no, I did not have to kick in per se. Now, on the debt side, the payments were always due. They always got paid. So I'm sure there were payments that were higher than what I received in.
Right.
But it's just part of the bigger machine.
But I guess that's really one of the benefits of having a bigger portfolio like you have, is that you have so much cash flow that you're not having to dip into savings when you have a couple of bad months. So that's great. Now, one of the other things that you've done recently is you've kind of moved up market in the rentals that you're buying. Tell us what you're doing.
Well, my goal has always been to buy single family homes or properties that hit the 1% rule. For people that don't know what that is, 1% of the purchase price. So if it's $250,000, it rents for $2,500. That's the goal. Those deals are just simply very, very hard to find in the DC metro area. They exist in nooks and crannies of bad pockets or condos or different things, but generally hard to hit. I had an opportunity to buy a home in Bethesda, Maryland, which is a very high-end, nice area, very, very good property. And I could buy it for $650,000, and I could have sold it. I could have flipped it. But if I flipped it immediately and made a good amount of money, I would have owed taxes. I would have been right back to square one and wondering what to deploy in or what to do. So I decided to hold it. That property was $650,000. It rents for $3,600 a month. The numbers are not great, but it's such an incredibly good asset. I couldn't turn down the long-term play of just holding it.
Right.
So I bought that, and I had another property that was a little bit better than what I normally buy. And of course, shortly after I bought it, they announced a Wegmans is coming in nearby it. It's not far from Metro, and the value has gone up. I could sell it, but I just don't want to because I just see a lot of these assets have a lot of improvements going on all around them. That tends to be happening actually in the DC metro area these days in areas that are 30, 40, 60 years old. So I'm just holding. I'm playing that holding game, and I'm okay moving up market if the property is right.
Yeah, I feel like a lot of times as rental investors, we really get focused on cash flow. But when you're in a good area like that is growing and developing, there is a lot of potential, a lot of upside for appreciation. So it sounds like you're
and it's interesting on that property, just so your listeners know, people think about equity. Well, if I buy something for $650, I need $130,000. If I buy something for $100,000, I only need 10 or 20. That property appraised for $800. I didn't take a traditional Fannie Mae loan. My bank gave me $600 against it. So I was able to have $600K of kind of, capitalization, less than 10% down. And that's with a non-traditional, non-Fannie Mae product. And that was good. I saw my dollars in on that house was only 50, 60,000. So I am getting a return on my equity. But I didn't have to drain funds to dive into that property. So if you can buy a good property at a good enough price, your bank in many ways and many times could give you the capitalization that will make it more desirable for you.
Right. Now, let's talk about, I think, the most exciting thing that I've heard in a long time about the free house that you recently got, the free rental.
Well, nothing's free. Nothing's free. I had an opportunity where I own those condos. A lot of the condos were owned by investors in an investor group. So there was a very small amount of distress. The reason why the prices plummeted and why I started buying there had to do with a fallout of Fannie Mae and FHA financing. In other words, an end user really couldn't buy it unless they paid cash. So I knew a group that owned 11 condos in the complex. And I was a buyer around 90. They were liquid around 110-ish, but they didn't want to go through selling them off one by one. So I said, look, I can pay you $1 million for the 11 condos. So it was $91,000 a piece. I knew a lot of friends of mine that were like, hey, if you ever get a condo there at a good price, let me know. I'd buy them. So I turned to a couple investors I know. I said, do you want to buy these units? I'll sell them to you for $100,000 a piece. They cash flow. They're good. They rent for $1,300. They have condo fees and taxes and this and that. But generally speaking, they're pretty good and there's a lot of upside. So I was able to sell 10 of those units off at $100,000 a piece. That was $1 million for 10 of them. But remember, I bought 11. So I basically got the last unit for free. I cherry picked the unit that I wanted and I did it. So think of it as like a wholesale deal. Yeah. So I have the contract. I got the 11 under contract. I sell off 10. We all went to the table at the same time. The seller didn't care. They got their $1 million. Right. And for me, basically I had a fee on each of the 10. That money was applied to the 11th. It was still income to me. I mean, it was still, it's not free. I owe tax on the purchase, but it was a good unit that fell out kind of into my lap just by being a little bit creative and making the deal happen.
And you never had to close on the other 10 properties. Like you really just wholesaled them.
No. So what I did was I had a contract for 11 of the properties and we had an individual HUD for each of them. The HUD had the purchase price of $91,079, whatever it worked out to mathematically. The delta between that and 100 was the assignment fee to me. And then I closed on the last one with basically a credit of all those assignment fees. So no, I didn't have to close on all of them. We closed. Everybody closed simultaneously. It was blind. It wasn't blind to the seller, but it was negligible. It was of no consequence to the seller because they got what they expected. Right. And for me and the people that bought it knew exactly what I was getting out of the deal. There was nothing hidden. Yeah. They just, everybody was happy. And that's great. Of a pretty good deal.
Now, how has it been working out so far?
That's a funny one. So the buyers that took the 10, I told them, hey, I'm going to cherry pick one unit for myself. And I did. I took a 2-bedroom, 2-bath that had been rented for $1,600 a month, a little bit higher than normal. And I cherry picked it. Nobody cared. Everybody was fine with that notion. I took that one because they had a tenant in there for 6 years. It hadn't left, had never been late. And right after I bought it, that tenant vacated. So, Murphy's Law. It's totally fine. And it's rented now. And that's Murphy's Law. And another interesting thing with that unit in particular, the air conditioning went bad about 2 weeks before I bought it. And the seller says, hey, this air conditioning's bad in your unit. I said, it's July. Your tenant's in there at 100 degrees. You got to fix it. It's not my fault. So it did come with a new HVAC. So I guess, all's fair. It all balanced out.
And did you get it re-rented for $1,600 again?
Yeah, I think it's rented for $1,585, and that happened within about 2 months.
Okay, well that's great. $1,585 with no mortgage, and of course you've got taxes and the HOA fee and all that. But that's a great deal. That is really awesome.
It's a really good deal.
Yeah.
Well, that was the whole reason why I held it. At $1,585 less, a lot, called $500 a month of condo fees and taxes and this and management fees. Let's say that thing pays $10,000 a year net of everything. If I had taken in the 90 of assignments, what would I have? I wasn't going to find anything that good.
Right,
So,
no.
holding it was just a good investment overall.
That is really awesome. Now, let's break out your crystal ball. So if you work in finance. I mean, you're doing hard money loans as your main business, and you're pretty attuned to the market. Where do you think things are going from here? Like, should investors be concerned?
I think investors should be concerned. I think it's a very odd time. You have short-term rates that are actually pretty high. They've driven up kind of variable rates, people to have ARMs, adjustables, LIBORs, people like me who use lines of credit. Long-term rates have actually held relatively low. So it's what you call a flat year, almost an inverted yield curve.
Mm-hmm.
It's bizarre in that sense, which has been fine because investors that are buying are still getting the same long-term rates that they're accustomed to, 4.5%, 5% type of stuff. It can't stay like this forever. Rates are rising. Something has got to give. The value proposition on rentals has shifted. It's gotten a little more expensive to buy, yet prices haven't decreased at all.
Right.
So I am kind of in a kind of holding pattern, sitting back watching, because there are so many investors out there. There's so many chefs in the kitchen that it makes it very hard to find a good deal. And it won't be until there's a shakeout of some sort that opportunity really starts presenting itself in this market. There's different markets in the Midwest that always have opportunity, but in this market, especially the metropolitan areas, the prices have been, they just are starting to not make sense. They're similar in a sense to 07, 06, but the crash capability, the crash tendency is much, much lower because the numbers aren't quite as out of whack, and lending is it's a lot tighter than it used to be. You still have, back then you could, just have a pulse and a credit score and be fine. So there are things in place to prevent what we saw 10 years ago. But I do think something has to deflate, and I'm not sure what it is, when it is. I'm just kind of in a holding pattern, and I could be wrong. I know a lot of people that felt this way in DC 3-4 years ago, and prices continued to go up and up and up. So none of us know for sure.
Yeah,
it just something feels. I go with my gut. Something feels a little bit pricey right now.
Now, do you think that there might have to be some adjustments made to the 1% rule as rates rise? Because the 1% rule works great when rates are 5, 6, maybe even 7%. But if rates were to go up to like 8 or 9% for investment properties, do you think the 1% rule would maybe not apply anymore?
So that's a good question. I think that the 1% rule things would change dramatically if rates went to 8, 9, 10%. Okay. Mm-hmm. And I don't think they are going to. We don't have a lot of inflation. There are different things that are sort of in check in the economy. Not many listeners remember the early 80s. I was kind of a kid, but I do remember rates being 15, 17%. My mom putting money for me in a CD at 12%. Things were completely, things have to adjust when and if that occurs. I think we're going to stay in a stabilization range with rates between, call it 4.5% and 6.5%. And that's kind of a normal range. If rates long-term go to 9, 10%, then yes, prices have to adjust because it comes down to affordability. Interestingly enough, I read an article recently about rising rate environments and house prices. And a lot of people would think rates rise, prices have to drop. And that's somewhat true, but there's other variables in play when you have rising wages, different things coming into play. And in past cycles where rates have gone up, property hasn't fallen the way people thought it would. So I'm not exactly sure what will happen. I feel like right now the value proposition is it's just not as desirable as I'd like. I certainly hope it expands.
Right. But you are buying, right? I mean, you've bought places recently, so you're not so concerned that you're selling off your portfolio, right?
No, I'm not selling. I will always be a buyer. I'm just a buyer at the right price.
Right. Okay.
And those are metrics I try to determine. If I get an opportunity that I think is a good value, I'm a buyer.
Yeah.
Because I always feel like if it's good enough value, I can sell it. If I want it, I have options.
Right.
What I don't want to do is back myself into a corner on a property where the only option is renting it. I have to buy it well enough that if I don't love the deal, I've got a little padding to sell it.
Yeah. Yeah, I think that's really
But I don't
good.
sell anything
Right.
anyway. So
Right. Now, as we kind of wrap things up, I want to talk about one other deal that you did recently that I think is pretty cool. So you bought a beach rental, which is a little bit different than the rest of your properties. And you decided not to rent it out weekly or nightly on Airbnb. You decided to go with a year-round renter. Why did you decide that?
That's a wild story. So we bought a place for my family to use as a personal residence, non-business asset. And we had an opportunity to buy something else at the beach, which was exactly where we wanted to be. And we took that opportunity. So I was left with the property that we had. And it was like, oh my God, well, I need to sell this. I need to do something with it. Tried to sell it, but it came to market in October. And I mean, why would you buy a place at the beach in October? You're going to have to carry it through, the season. The time to buy at the beach, when everybody buys, is kind of February through May. And about a month or so into it in November, I said, a lot of people are moving to this area and they're buying property to retire at. There has to be demand for people to dip their toe in and rent a nice asset year round. So I listed it for rent as a yearly rental. Just to segue back to your question about the Airbnb and stuff like that, I did not want to do weekly rentals. It would rent quickly, but I was moving the furniture to the new property. So a weekly rental needs to be furnished, and it just wouldn't work as a weekly rental. So we put it on the market, and sure enough, within a week, in a dead market in December, we got an applicant that wanted to rent it for a pretty good price. And that price covered everything, and it made it made all the numbers work, and it stopped the bleed, so to speak, on the property. Yeah. So that's what I've done.
And so you don't feel like you're leaving a lot of money on the table, because you could probably rent it for a much higher amount if you rented it out weekly, right?
So I could rent it for a much higher amount weekly in the summer, but my annual monthly rental. So let's just use real numbers. Let's say it would rent for $3,000 a week in the summer. That's $36,000 for the summer.
Yeah.
Its rent for the yearly rental is $29.95 a month. So they basically rent it for the same price for the year as you would for the summer. They get the off season for free. However, for me, I don't have tenant transition. I don't have ups and downs. I don't have to provide it furnished. So it nets to the same spot, but the wear and tear and the other factors aren't there, and it's out of sight, out of mind. And of course, I put the guy on ACH auto payment, so the numbers all kind of play out. I ultimately, if he wants to stay forever, that's great. If he wants to buy it, that's okay too. I'm somewhat complacent. It doesn't matter much, but it was a good back out story of a rental that wasn't planned to be a rental at all.
I think that you actually made the right call on that one, because it's like, if you think about it, you're probably, if you're renting it out weekly, you're probably going to be vacant most of the winter anyway. And you do have a lot of hassle with turning the property over every single week.
Yes, definitely.
So,
definitely. And at the beach, historically, LongTerm has slightly better appreciation than other areas. So if I just hold this thing, set it and forget it, it could be very good. My grandmother bought a property in 1975 for $80,000 at the beach. It's now owned by my aunts and uncles who are in their 80s, and the property is worth $1.3 million for the dirt. So you never, And she was not a wealthy lady. It was just to cover itself and to have a place for family. So long periods of time, if you have somebody covering your debt and hopefully giving you a little bit of profit, long periods of time, appreciation does kick in. A lot of people who are 40-ish years old say, hey, I bought a property 12 years ago. It hasn't gone up a penny. Let's see what happens in 15 years from now, because over very long periods of time, things do adjust.
Absolutely. Well, Rich, tell us about your business. So if someone is looking to flip houses in the DC area and they're looking for short-term financing, that's your specialty. That's your business.
What we do is we provide capital to people that are flipping homes. So basically, it's short-term capital. A lot of people that are listening probably are looking for longer-term capital. We can be a bridge on that. Ultimately, we need to be. You don't want to use hard money because it's a little too expensive for that. But we can be a good solution for that type of borrower until they get their bank financing in place so they can close quickly. And we help a lot of borrowers buy homes, renovate them, and flip them where their capital source. And we've helped a lot of people make tens of millions of dollars over the years just by being their capital partner. We provide first trust capital for their homes that they're flipping, and our typical loans are $100,000 to $700,000 on property in the DC metro area, up to about 50, 75 miles around. We're starting to venture into Pennsylvania and New Jersey through some affiliate relationships that we have. So we're kind of a mid-Atlantic private lender.
If you're looking for short-term financing on your next property, definitely reach out to Rich. He would be happy to take a look at it, give you an opinion on it, and go over some of his financing programs. The great thing with Rich is he can close very quickly. So if you find a good deal and you've got to close quick, talk to Rich. He can make it happen and get it done for you. I've got Rich's contact information on the website. You can find it at rentalincomepodcast.com/episode 194. If you're looking for long-term financing on a rental property, whether it's your very first property or you've got a large portfolio and you're having a hard time getting financing, reach out to Chaley Ridge. She can make it happen. She's a great lender. She's got really competitive rates. She's the lender that I recommend, and she's a big fan of the Rental Income Podcast, and she loves helping listeners get rental properties. If you want to contact Chaley, I've got her contact information on the website. You can find it at rentalincomepodcast.com/episode 194, or just head over to ridgelendinggroup.com. If you mention Rental Income Podcast, she will waive all of the pre-qualification fees for you. Her NMLS is 42056. Thank you so much for listening and subscribing to the podcast. We'll be back with a new episode next Tuesday. My name is Dan Lane, and this has been the Rental Income Podcast.